week's market update. Wall Street hits new records a year on from Trump's inauguration. The great and the good gather in Davos, and key central bank meetings and a raft of corporate results make for a busy week. This weekend marked the first year of the Trump presidency. 12 months on from an apocalyptic inauguration speech, his warnings of American carnage look bizarre from the perspective of Wall Street. The S&P 500 spent 2017 hitting new record after new record. Stock market investors have rarely had it so good. It would be wrong to attribute the surge in the US equity market solely to Trump, but he can take some credit. The tax reforms he promised in the 2016 campaign were finally delivered just before Christmas, while many of the things markets worried about, trade wars, the end of NAFTA, have been avoided or at least postponed. He's also done his bit to talk down the value of the dollar, making US exports more competitive and boosting the value of American companies' overseas earnings. The reality is that the dollar would probably have fallen whatever he had to say, because the rest of the world has caught up with America's economic recovery. But it has certainly been a factor. A key beneficiary of the weak dollar has been the pound, which this week briefly rose above $1.40 for the first time since the EU referendum in June 2016. Sterling is rising on hopes that a cliff-edge exit from the EU in March next year now looks less likely. Wall Street's relaxed mood comes despite the partial shutdown of the US government, as Republicans and Democrats failed to agree a compromise deal to keep funding the public sector in the weeks ahead. Investors took the view, rightly, judging by developments so far this week, that a deal would be achieved before any serious damage could be done. There have been 18 government shutdowns in the past 40 years, lasting between 1 and 21 days. The latest one looks like being one of the shortest at just 3 days. Looking into the first half of 2018, it's likely that these tailwinds will continue to underpin Wall Street. Further out, the outlook is less certain. For one thing, at 2,800, the S&P 500 is increasingly dependent on strong earnings growth being delivered. Valuations are high by historical standards. The second potential headwind comes from the bond market, where rising yields threaten to spill over into equities as they have in previous tightening cycles. In the past, the bond market has had a negative impact on shares once the yield on 10-year bonds starts to look relatively attractive compared with the likely return on equities, which falls as prices rise. The crucial crossover will happen if share prices maintain today's levels while bond yields rise above about 3%. Now, the yield on 10-year treasuries is currently 2.64%, so we're not in the danger zone just yet. But bond yields can spike quite quickly if the conditions are right. Investors' biggest fear right now is that Trump's tax reforms are pouring fuel on an already smouldering economic fire. If tax cuts are passed through to workers' salaries, then rising inflation could trigger a faster monetary policy normalisation than is currently expected, and that in turn would push bond yields higher. Worries are also rising about the high levels of corporate bond issuance and the increased risks that bond investors are happy to take. So, we may be in the early stage of this bull market's final chapter, but there seems little doubt that we are entering the home straight. Well, that's the market backdrop to this week's gathering of the great and the good in Davos in the Swiss Alps. The annual meeting of the World Economic Forum is an opportunity for business leaders, investors and politicians to network, but it also acts as a kind of barometer of what the global business community is focused on. This year's gathering, which begins today and runs until the end of the week, is shining the spotlight on global cooperation in trade, the environment, the fight against terrorism and tax policy. What makes this all the more interesting is the fact that Donald Trump, elected on an anti-globalism platform just over a year ago, will be giving a keynote address on Friday. No one really knows whether he'll choose to deliver what the global elite in Davos wants to hear, or to play to his supporters at home with an America First slap in the face to the bankers and investors enjoying their cocktails in the mountains. The Davos meeting got off to a positive start with upgraded global growth forecasts yesterday from the International Monetary Fund. It said that the world was enjoying the broadest synchronized global growth surge since 2010. The IMF said that the world economy was likely to grow at 3.9% this year and next. That's up 0.2 percentage points in each year. The US is forecast to grow at 2.7% this year. That's up from a previous forecast of 2.3%. The IMF said that by 2020, Donald Trump's tax cuts would boost the US economy by 1.2%. Now that optimism was matched by a survey of chief executives by PwC, the professional services company, which showed a jump in confidence about corporate prospects. On that corporate front, it looks like being a pretty busy week. US earnings season is in full flow after the banks kicked things off last week. They highlighted an irony of the current steady-as-she-goes bull market, that it's bad news for big banks' trading operations. That's because the current strong market rally is coinciding with a period of unusual calm. This week, Wall Street broke another new record, this time for the longest period ever without a 5% correction. Stock and bond markets are as tranquil as a mill pond. Now that's bad news for traders because they thrive on volatility, which encourages buying and selling of investments. In today's environment, everyone prefers to just buy and hold. That's great for investors, but bad for traders. Goldman Sachs' core fixed income, commodities and currency operation saw its revenues fall 30% in 2017, although that didn't stop the world's leading investment bank generating $32 billion of revenue, $8.7 billion of net income after holding back $12 billion in compensation and benefits for its 36,000 employees. Nice problem to have. Other results to watch out for this week include Procter & Gamble, the world's biggest household products company, Caterpillar, Netflix and Starbucks. So covering a wide range of different sectors, these results will provide useful insight into the US economic cycle, but also into how companies are viewing the looming tax cuts. On this side of the Atlantic, the focus on retail is shifting now to another aspect of consumer spending as a raft of pubs and restaurant chains report on trading. Frankie and Benny's and Garfunkel's owner Restaurant Group is joined by Wetherspoons, Fuller's, Green King and Marston's this week. Also reporting are Sky and EasyJet, so some good corporate insights on this side of the Atlantic too. On the policy front, both the Bank of Japan and the European Central Bank have meetings this week. These should shine a spotlight on the extent to which these central banks are preparing to follow the US down the tightening path this year and next. The ECB in particular seems to be on the cusp of reining in its stimulus of the European economy, which appears to be firing on all cylinders. The ECB has already trimmed its purchases of bonds from 60 billion euros a month to 30 billion from this month, and the expectation is that QE will come to an end in September this year, a bit sooner than had been expected. The first Eurozone rate hike in the current cycle is expected early next year. Now in Japan, it's a similar story, although with inflation still below target, the BOJ is not expected to tighten policy anytime soon. It will probably maintain its promise to do what it takes to keep bond yields at or around zero. But with growth picking up, it must only be a matter of time before Tokyo too joins the global tightening cycle. The economic drivers of tightening policy will come into focus this week as we get to see the latest GDP data on both sides of the Atlantic. Fourth quarter activity for both the UK and US will be unveiled on Friday, with both sets of data expected to confirm the synchronized uptick in global growth. That will provide support for former Goldman Sachs economist Jim O'Neill, who this week backtracked on his previous Brexit pessimism when he said that the global recovery had the potential to more than make up for the negative effects of Britain's decision to leave the EU. And finally, on the employment front, Wednesday will see the latest update on UK wage growth. This is a key focus for UK economists because sterling-fueled inflation has left household earnings lagging behind in real terms in recent months. Unemployment at 4.3% is at its lowest since the 1970s, which might otherwise be expected to boost earnings growth. The absence of wage growth and the breakdown of the link between employment growth and earnings is one of the big mysteries for economists today.